Hey, good evening, everybody. Welcome out to tonight's weekly training webinar for all of the members of Tax Sale Support. Thanks for joining us live. We really appreciate it. Looks like we've got a lot of you.
Yeah, absolutely. We love having a ton of members join us each week. It helps keep us motivated because we have people we can see that are interested and participate. So we definitely want to thank you guys all for attending each week.
Yeah, and feel free to ask questions throughout the webinar. We enjoy getting them, and you're always welcome to ask.
Yeah, definitely. Now, as far as tonight's topic, we're going to be going through and talking about tax sale investing risks. It's kind of a question we get a lot from our membership is, what do I need to watch for? What should I, look out for? And so we want to go over some of that this evening.
Yeah, but before we do that, for news and events, the first thing to talk about that's important coming up here is the Orlando 3-day Investors Boot Camp that is scheduled to take place on December 13th, 14th, and 15th. It is filling up really quickly here. Oh, sorry, I guess I went backwards. So it's filling up really quickly. It's actually already more than half filled, and it's basically filling up a lot faster than our last event filled up. And so we wanted to let everybody know because we know there are a lot of you that would like to attend, and we don't want you to miss the opportunity.
Yeah, absolutely. So if you'd like to attend, let us know. Go ahead and give us a contact, and we can get you all worked out. We've already got the location set. I believe it's going to be at the Marriott there in Orlando. So the last event was our first event of this type. We've been teaching events since 2007, but this is the first type that we had where it was through this new company that we were doing it ourselves, and it really gave us a chance to meet a lot of our members, talk to them in person, and it was really just a great experience, at least for me.
Yeah, no, I think it was good for them too, and it's also an opportunity for us to really get to know who you are, and I mean, for instance, it's like now that we've done it, I mean, we know exactly who Holly and Greg are. We know exactly we know exactly who Esther is. We know exactly who a lot of these people are, that attend the event, and it also helps us, I think, in helping them to more effectively pursue their goals.
Yeah. In fact, we had some people that were just brand new members that attended, and were able to take that knowledge and go out and buy tax liens, or even take that knowledge and go out and buy tax deeds in one of the upcoming auctions, just by, really kind of coming in brand new to the experience or to this investment, but just through that experience able to take that knowledge and do deals within a day of the training.
Well, yeah, and then one more thing that we also need to mention is that for this 3-day, we're doing something we haven't done in the past, which in the past you had to get an additional ticket for a second person, but each ticket you buy for $9.97 is going to include 2 seats. So that is something as well we wanted to let everybody know. So that can be you and a partner or a spouse or whoever it is you want.
Yeah. So this is for members only. If you're interested in that, or you would like to bring a guest for the $9.97, go ahead and let us know, and we'll make sure that gets taken care of.
Yeah, definitely. Yeah, so tax sale risks. I think when it comes to tax sale investing, there are a lot of risks that are out there. Although I think how easy people can see them or what they are isn't always very evident.
Yeah. Well, and as you get more experience, then the good properties almost show themselves, or the bad properties show themselves. They start sticking out, whether that be good or bad.
Yeah.
Because as you're going through, and we're actually going to be talking about the top 10 tax sale risks. So there's probably some other risks, but these are going to be the big ones. And as you're going through and you're looking at a property, essentially checking off each one of those, then you're just ensuring that you're going to be making a safe investment.
Yeah. Interestingly enough too, a lot of the risks are the same whether you're buying tax liens or tax deeds. They kind of apply to both in general. There may be a few things that are tax lien specific, but for the most part, they kind of apply a lot of them across the board.
Yeah, absolutely. And really, you're going to be looking at the same things regardless if it is a tax lien or a tax deed. Now, with tax deeds, we're going to get into more due diligence, something like governmental liens that we may not check with the tax lien certificate. So there will be some certain things that we may do additional research on a tax deed that we may not with a tax lien, but these are all things that we're going to be looking through.
But as we talk, so we've got the list here. We're going to start going through of all of them, but even something like worthless land, we don't want worthless land for liens or deeds. And the same will apply for all of these. And so we're going to talk about how each one of these plays a factor, how you can avoid them. And one of the things to also take away from this is the fact that you don't have to be terrified, of the risks that are out there, because the risks do tend to reveal themselves. And the best way to root out the fears is just to educate yourself about it.
Yeah, absolutely. Well, and lists can vary. You'll have some list where 90% of it is junk, and only 10% is those good properties. And you'll have other lists where, even the one that we were going through with the coaching students today, and I'm sure there was junk on it, but there was 80%, 70% of what we were looking at was good.
Yeah, it was all pretty viable, which we'd love to see lists like that, as well. But yeah, useless land is going to be the first risk. It's one we're going to avoid with either with liens or with deeds. With deeds, we don't want to own property that doesn't have any real use or value, and we certainly don't want to own any liens against a property that doesn't have any use or value, because really a lien is only as effective, or only as valuable as the property that's placed against.
Yeah, absolutely. This is probably one of the number one things we need to avoid, because there is so much of it. There is so much of this different types of useless land that we need to really do our due diligence and research to make sure that the property has, like Shade said, use and value. It has an intended use. For example, if it's a building lot, it can be built on. It's not just a side lot that can't be built on between two homes. A 20 by 100-foot side lot isn't going to do anything for us. Nothing can be done with it except for possibly sell it to one of those two neighbors, and one of those two neighbors is possibly the one who quit paying the taxes to begin with.
Yeah, that's the problem we're going to run into with things like a side lot, is that its value is always going to be very limited. It's always going to be limited to the people that may want it or that could potentially use it, and oftentimes that's just basically one party.
Yeah, we want a property that can be sold to anyone, not just one or two parties. Any property we want, even if it's a building lot between two homes, those property owners on either side of the home are going to be some of the top people that we're going to send out a letter to and let them know that's available. But we don't want them to be the only ones that could buy it.
Yeah.
Or the only ones that have a use for it. We want to be able to say, hey, I can build a home, put my home on there.
Yeah, and considering who your potential buyers are going to be is one way you can avoid risks. It's to think about who you're going to potentially sell this property to, who might be the type to buy this before you do so, and that will help you avoid buying stuff that you're not going to be able to sell.
Well, and really where the research comes in is being able to review and research the GSI maps, because you can look at just the basic information. In fact, we were just doing that just right before here, where we're looking at properties that had a good assessed value and had good size, but it was landlocked.
Yeah.
So, it could have possibly had a use, but we're limiting our use to where, just possibly the neighbors could be the one to buy if they won't give us access to the property, unless there's already some type of easement that gives us access to the property. So, in that type of scenario, even though the record looks good, if we're looking at the paper record, until we got onto the GSI map, found the location, we weren't sure what it was.
Yeah, that's true.
Because it had value,
And just so everybody knows, there's a difference between a real world value and simply the value that the assessor attaches to, the property. The reality is the assessor attaches a value to every piece of property within the county. That's part of how things work. That's how they come up with their, with their formula. It's how taxes are assessed, but it doesn't necessarily mean that somebody is going to pay that much for the property. That's why sometimes we also get a difference between the assessed value and an actual, market value, is because they're not always the same. But it's often, we see properties all the time that the county may slap a certain value to, but in reality, that property's true value is zero.
Yeah. Well, like that 5-acre parcel that I was mentioning before, the 5-acre parcel was, valued at 60, 70 grand. It actually was a nice piece of land. The only problem is, unless there was an easement, or we got an easement, or somebody, got permission from one of the property owners to access the property, we don't have any way to get on the property. And so, just like Shade said, even though it does have value, it doesn't really have use because we can't, use it.
Yeah.
So, really that takes the value down to zero.
Yeah, now useless land can be a variety of different types. It's not always going to be, a side lot,
or landlocked.
Yeah, or landlocked. It can be all sorts of different things. We see, but generally speaking, though, useless land is oftentimes landlocked. It can be drainage ditches, or be property with that has easements.
Yeah, I was just looking here. I must have really thought landlocked was important because I put it number 1 and I put it at near the bottom as well. I put it on there twice. But yeah, these include things like drainage ditches, water basins. Sometimes you'll get properties where it's nothing more than a dirt road, and they're selling it as a tax deed. Well, you could try to buy that road and see what you could do with it, but there really doesn't going to have any value to it.
Yeah.
Plus, desert land, swampland, wetlands. In fact, another property we were looking at before as well, I'm sorry to keep reminding it, but in talking useless land, it just was something we just looked at, was some property that was, looked pretty good, but then when we looked at the topographical, it was, on a very high hill.
Yeah. There was about, it was like a 200 or 300 foot elevation, increase.
So, acre and a half, had size, was worth 60, 70 grand, had value, but really didn't have any use unless you were to, try to build something on the side of the cliff.
Yeah, which totally changed everything about it. It basically, because of where it was located at, it took a piece of property, from something that could have value to basically having a value of zero, even though the county, gives it a certain amount.
Well, and as you're looking and using the GSI maps and looking over this information, the useless land is going to start to show itself. I know we mentioned that before, but you're going to be able to see automatically. If the lot is much smaller than all of the lots around it, that's going to be, that's going to be something. That's something that's suspicious for us. Even, and it's going to depend upon the area as well. For example, some areas you could get a building lot as small as of 1/10 of an acre, and it still has use and value. Maybe it's a mobile home lot, something like that. Where in another area, maybe the biggest the smallest lot that you have to build in out in the country is an acre, and this is 1/3 of an acre, and it's really almost actually more of a side lot, because you have to have an acre to build in that area.
Yeah, we always base it on what we see with the properties around it and how it compares to those properties. That's probably one of the biggest tools that we use as we're trying to evaluate property, is just comparing it to other properties. What we're also trying to see is, Yeah, if it was one of the original lots that was intended to be used, or whether it was something that was like an afterthought, or whether it was an extra.
Yeah.
Because sometimes we can see that as we see overhead images as well, is if this was a community and this piece was just something that was kind of left over, it's tough to use.
So the next thing we're gonna talk about is emotional bidding. And emotional bidding is really something that's more about us than it has to do with the property.
Yeah, and at the same time though, because live sales and online sales, are such a big part of being able to get tax liens or deeds, it's something that we need to address and understand and be able to cope with. We need different ways around becoming emotional about our bidding or getting involved that way.
Yeah, well, if you've ever competed in some type of even eBay auction, or some type of charity auction, or any type of auction where you felt that bidding, you wanted the item, you were bidding on the item, you tried to win the item, then you know what emotional bidding is. And that's what's most important with emotional bidding, is recognizing it. And by recognizing it, then we can essentially avoid it.
Yeah. Now, Diane had a good question here. When we were talking about thin plots, she was wondering, how thin is too thin, to build on? And, that is a question that's going to have different answers depending on, in different parts of the country, because in the past, traditionally, lots were shaped long and skinny because, a lot of times they were property owners were trying to get access to water, and so they tried to have long, skinny lots that would take you back to water or make it more likely. But now, so it doesn't quite matter so much. So for us, when we consider it to be too thin, it's usually kind of depend on what we see with the properties around it. But if something's like more narrow than I don't know, if it's more narrow than 50 feet.
Yeah, 50, 60 feet, we're going to be a little pretty concerned about it.
Yeah, because that's pretty narrow.
And you could find, a mobile home lot that could be something like that and be a little bit longer. But that's where, Shake mentioned that we're going to look at what's similar. So, if there's a bunch of lots that are, let's say 60 by, 150 feet, and in that area, there's kind of like those little bit longer, not townhomes, but kind of those row homes, where they're kind of a little bit longer style homes, thinner, and there's similar homes on that street, and there's an open lot. Well, then it's probably going to be okay, because we can see that there's other people that are using those same lots.
Yeah, and it seems to be standard in the area.
Yeah.
Sometimes in parts of the Northeast, I know that they have lots that tend to be thinner and deeper, because that's also how their buildings, work as well. You've got houses and stuff that are, fairly thin, but they build them deeper, deeper back. But yeah, so we would say it's, it's hard to have a set number, but 50, 60 feet, anything under that, we have questions, and we're always going to look at the maps too, just to know for sure.
But, yeah, well, and you can always, call the city, or if it's a county, if it's within the county area, and it's not that the zoning isn't within the city, then, check the county and find out what the building restrictions are within the city planning. And so, then you can get an idea, yes, this is perfectly fine, I'm good to go. So if you do have, a question, that's always something you can follow up and find out for sure, but just by contacting the city.
Yeah. Now, when it comes to emotional bidding, the biggest thing for us is going through the preparation to make sure that we have preset limits on what we're bidding on. We've done our due diligence. We've basically gone through the things and done the things we need to do in order to not become emotional about it. But it can also be valuable, though, I think, to be able to recognize the emotional bidding, that we're seeing taking place as well, or just recognize it in other bidders.
Yeah, well, it can happen to everyone. I mean,
yeah.
It's happened to all of us. When Michael went out, and Michael doesn't think I'm throwing him into us. He ended up going over his by a couple $100 in a bid, just because you want to get a property, you've put in all this work, and you know, and if it's a couple $100 to get the property, it's not going to make a big deal. But that's where the danger lies, is where suddenly you planned on paying $5,000 and next thing you know, you ended up paying 10.
Yeah.
You know, he thought, well, the property's worth 20, so I'm still making some, okay.
Yeah.
You know.
Yeah. It's easy to make justifications sometimes, you know, to ourselves, you know, when we're doing that, because we are being emotionally manipulated. You know, we're emotionally manipulating ourselves.
Yeah, exactly. And so as long as we're aware of it, we've set our bidding limits, we know how much we're going to pay, we've done the due diligence, then we can go in there, and if we end up losing it, we end up losing it. You know, it stinks to lose a property by a couple of $100 and having, you know, somebody out bid you on it. But, you know, it's going to be a lot less painful than overpaying for a property and now finding yourself in a situation where you're losing money.
Yeah. So really, some of the easiest ways to avoid emotional bidding are just by going through the motions, doing your due diligence, and setting limits. I think it's also about trying to. All of us, can come across properties that we really love and that we want to try to land, but I think we try to avoid taking excessive ownership over the property before we want it.
Oh yeah.
That's always an indication that we're getting emotional about it. Is if we start talking in possessive terms, and if we're we know how we see it in ourselves when we do it.
Yeah, and you're going to have that just a little bit naturally, but it's about putting that in check. You know, the emotional bidder is not going to have bidding max bid set. They're going to go there and maybe they have an idea. Well, it's worth 80. I looked up on Zillow, it's worth 80. So maybe I'll pay 15 for or 10 for it, and then it gets the auction. Next thing you know, they're bid up to 40. And also one thing to bring up when we're talking about emotional bidding is even the auction itself. And you can see this with online, but especially at a live auction, where people will bid just based off thinking that somebody else knows more than they do.
Well, when you have a live sale, I think that the competitive nature of the auction is only heightened, because people are kind of they're experiencing the bidding and the wanting of it and placing additional bids, and and the auction experience itself of going from being the high bidder and winning the property to to having somebody else outbid you. Everything about that process is designed to have you take increased ownership in it.
Yeah, well, we've seen two bidders bid on a property that they hadn't researched, that was a total junk property, and they were bidding against each other just based on the fact of ego and based off the fact that they thought the other person knew more. Well,
that was kind of when we finally figured out that they didn't know what they were doing. Was when you attend an auction, if you do research on properties, then you will know basically what's happening here throughout the sale on different properties. And we had researched enough of them. Like I said, we used to spend way too much time doing research, but we had researched everything and we knew, what these properties were. And so, it wasn't until then they just seemed like they were aggressive bidders, and we might have mistook them for being, educated bidders and knew what they were doing. But as soon as that property came up and we knew it was complete junk and we could still see them bidding with such crazy fervor, we knew that they didn't know what they were doing at all. Because we could see that crazy, they acted like they knew what they were doing. They bid like they knew what they were doing.
And everyone in the room thought they were new. And what was funny is the actual story we're talking about was one of the first sales we attended, probably, at least me and Shade attended together, probably 18, 19 years ago. And what was funny is that we didn't know anything at the time. I mean, I knew enough about real estate and being a real estate agent that we could look up county records, and we were able to pull up the records and do research. But We went there thinking that we were completely inexperienced and realizing that we had probably done more research on the property than anyone there that was buying.
Yeah. So, I think with auctions, just doing your research and and trying to set some some limits on it beforehand is usually enough. But also, just being willing to walk away from it if you can't land the property at the price you want, because price in the tax sales really what we can pick them up for price wise is our greatest advantage, that the tax sale offers.
Yeah, I mean, just the fact that you guys are on the phone on this call with us tonight, you're going to be more educated than probably most of the investors that you're going to be bidding against at tax sales. You're going to be more prepared. You're going to know what to watch for. And so when you do attend these auctions, I really think that you can be the expert in a lot of ways.
Yeah, it's definitely true. Now, the third risk we want to talk about here is liquidity. And I think what a lot of this is about is using the right funds on the right types of investments. Where people run into problems here is in not completely understanding investments and investing the wrong kinds of funds into the investments. So somebody suddenly buying a bunch of tax liens with their short-term funds while they're trying to build capital. Big mistake. Suddenly their money's all tied up in something they can't just pull it out of.
Yeah, in fact, it's a question we get all the time on YouTube and others, and you can always tell it's from somebody who's just getting started when they ask, now, do I get a check each month, for my interest? And it's not, you don't understand how tax liens work. You're not going to make any money back until either the property owner redeems, or the redemption period expires, or and you start the foreclosure process.
Yeah.
So it's really either going to be those two options. You're either going to acquire the property, do a foreclosure, or the property owner is going to pay before then. But until that happens, your funds are locked into that tax lien certificate.
Yeah. Now, this isn't really a problem, really, because most investments are time locked, to some degree. There are lots of other investments out there that are going to require, your money is involved with that investment for a set time. So more than anything, I think what's important is just recognizing the investment types that exist, out there. With liens, it's investing your long-term funds. If you're investing long-term funds, the same kind of funds you might have into a retirement account. Then I think if we're dealing with those types of funds, then I think the tax liens are an excellent way to invest it, because you can earn a better overall rate of return, much higher, I think, on those, on those types of investments.
Yeah, exactly. And so that's something to consider. You don't want to take your rent money and put it into a tax lien certificate.
Yeah.
Or even a tax deed. There's going to be a time frame, even if we're buying land, we want to give ourselves, or even a home, we want to give ourselves 6 months to a year to sell the property. Now we can sell it within, a couple of weeks, and that happens all the time, where you put it out there, you find the right buyer, you get to sell quick. But it could also take a longer period of time. And so we want to go in with that in mind. Now, I guess you could always sell out of a good tax lien and find somebody else to buy it from you. Say I needed to get out this money, and it was the only money I had, and so I sold my tax lien to Shade. Well, Shade's, for Shade giving the cash to the tax lien, he's going to want a discount. He's going to want to buy that tax lien for less than the tax lien's worth, because you're placing. So suddenly you're going to be taking a hit if you do that.
Yeah. And so for the most part, you're gonna end up sticking with them until the end result of the investment, and that's not going to be a problem, though, as long as you're using the right kinds of funds. And if that's the case, then there isn't really any kind of a risk involved with cash liquidity, other than just understanding the process there. And when it comes to real estate, 6 months is kind of short term.
Yeah.
So. Now, number 4 here is owner bankruptcy. And this is kind of an interesting risk, that we in the beginning we thought was more of an issue. Even now, it's something that is out there, but not necessarily something that we're constantly trying to guard against.
Yeah. When it comes to bankruptcies, usually the county's going to pull any bankruptcies before it goes to the sale. So they're not going to be selling tax liens that are currently in bankruptcy. They don't want to cause a problem, because it does cause, at least a time frame that's going to happen if it does happen. So they want to avoid that to begin with. So they'll go ahead and pull any of those that do have it. But if you do buy a tax lien, and it's happened to us, it happened to me. I purchased a tax lien, and about a year into it, essentially we were notified that there was a bankruptcy on the property. So what happened at that point essentially is I still got my money back, but the property owner had to essentially break that lien up into payments. So it was a $1,400 lien plus interest or whatever, and then they broke that up over 12 payments, or 10 payments, versus me getting back the full $1,400 at one time.
Yeah. So this is something that that can happen. There are cases out there where you could buy a lien against a property and only to find out later, that the lien is involved in in a bankruptcy. It's totally possible that it could happen, but even in that case, you're not going to lose your money. It's really what happens at that point is you just get your money back. You may not, continue earning a return. You might get back maybe what you paid them, but you're not going to lose your money. So in that way, we feel like it's a limited risk.
Yeah, we have never personally heard, and it may have happened, but we have personally never heard in our 20 years in doing this where a judge in a bankruptcy court has eliminated the tax lien. Because it's a governmental lien, even though we paid it and we owned it, it's still a tax lien, within the county, and so they're not going to eliminate that governmental debt. They'll eliminate other types of debt, other types of liens, but that tax lien they're going to stick. And so the worst case scenario, like we mentioned, it's going to be broken up into a payment program.
Yeah, we have a couple of questions here. And the first one here relating to the bankruptcy. So the only risk is if the bankruptcy is prior to the purchase. Is that correct? And what we're saying is that the county will naturally pull different properties if a bankruptcy comes up. So if they know there's a bankruptcy happening there, then they will pull the property there from the list. So oftentimes we're not going to see those properties or have an opportunity there to bid on them. But it's still possible that we could buy a lien on a property that is involved with the bankruptcy. That is a potential, and if that occurs, we just end up getting our money back.
Yeah, and there's a question about receiving. I think that the dean can an owner declare bankruptcy before?
Oh, after I bid, but before receiving.
If it says title, these are going to be tax lien certificates. So you're not going to really be receiving bankruptcies on tax deeds.
Oh yeah, sorry, we should have clarified that. So bankruptcy is not a possibility with tax deeds.
If there is some bankruptcy and the property was wrapped up within it, then they would get rid of those assets, or those assets would be distributed or paid back or whatever within the bankruptcy. So it's really, bankruptcies are only going to be on tax lien certificates. The county's not going to sell you a tax lien that has a bankruptcy. The only way you're going to get that is if it happens while you've already into the redemption period. And then at that point, they're going to go ahead and, pay you back. Either you could be paid back immediately when they do the bankruptcy and pay everyone off, or if there's not still funds, then it'll be set up in a payment program.
Yeah, and so really what we found is no matter what the owner declares or kind of how it works, if somebody, if an investor buys the lien, essentially pays the property taxes there, in doing so, we've never seen a case there where the county does, where they're not at least forced to pay that back.
Yeah.
So, that's something we've never seen before. Now, let's see here, the other question here, and I see Abe's got a question that I'm going to get to here. about the mobile homes here. Okay, so A's question here is, are mobile homes considered part of the property? Could it become a value issue if the owner takes the mobile home, or if the mobile home is junk? And it's actually a good question, and it kind of relates to something that we're always looking at with properties, and that can become an issue. But that is, buying properties, that are vacant land versus structured or improved properties. And mobile homes kind of ride that line sometimes in between, because they can be added.
The answer is both. There's going to be mobile homes that are, part of the property and is considered real property. Then there's other mobile homes that is just going to be considered personal property, and then the land is considered real property. So the trailer is going to be personal property, and it's not part of the land and not considered real property. So some of that's going to depend on the state. Some of that's going to depend on what type of property is or where it's located, because of course within a trailer court, those are all just going to be, essentially personal property unless those lots are individually owned.
Yeah. Now another question here Robert had is, will a lien on a second property of owner A affect the primary property in terms of selling the property or buying the property? And so if I'm understanding it correctly, if an owner, if a property owner has multiple properties there, and if they have a lien against one of their properties, will that affect the other properties in any way? And it shouldn't. That shouldn't be a problem there. Liens are generally property specific, unless it's something like so if the government were to issue a lien against the individual, then that could just go against any asset that the individual has, and in which case you could have everything could be at risk. But in most cases, though, you're not going to have to worry about liens having cross property capabilities. Liens are generally property specific.
Yeah. And one more quick point about the mobile homes and land. We're going to be able to find that information within the county record. So within the county record, if we see that the property has both, an assessed value on the land and an assessed value on the mobile home, and together a total value, that's going to be a pretty good indication that it's considered real property.
Yeah. But yeah, that's also something that we're always looking at there, is to see how the value's divided up.
Yeah.
Because that's ultimately what kind of tells us is how they have the value divided.
Yeah, well, if we only saw the value there on land and we know there's a mobile home, then chances are that mobile home is personal property, and it's not attached or does not have a foundation or does not qualify to be essentially real property.
Or it's not there anymore.
Yeah.
Which half the time, that can be the case too. Now, another risk or potential risk that exists out there is related to tax deeds, really only. And that is environmental issues. It could be some kind of an environmental issue on a property that you might be looking to acquire.
Yeah, and this is going to be really rare, but we want to bring it up. And so these are going to be essentially, like Shade mentioned, properties that are contaminated. They're going to require some special cleanup, or some skilled individuals to come in there and take care of it. And they're going to need something done to it because there's been some type of issue with it.
Yeah, well, usually it's the result of some kind of industrial or could be commercial use, and some kind of a spill, or at some point it was reported to the EPA, and the EPA is aware of some kind of a problem that was there. But environmental issues can also be things that would pose a potential risk or require additional investment. So, for instance, something like an old gas station could be an example of a property with certain environmental risks, because we know there are underground tanks, there are additional things there that could end up needing work.
Yeah, exactly. In fact, we use gas stations as an example because you wouldn't be surprised how many gas stations
see a lot.
We've seen come up to auction in all kinds of different states. you know, where this gas station has come up for sale, and that's where that could be a risk is, hey, look at this great gas station. Well, they've got those big, huge tanks underneath to hold gas, and if there's something gone wrong there, that could be, you know, a huge expense.
Oh, they've got to be updated and you know, there's a lot that goes into making them work properly.
Yeah, so it's not going to be on your residential building lot or most even your commercial land. It's going to be something that you know, is usually going to be a little bit different type of a property that you're going to look into. But on the EPA website, you can search properties by address and see if there is any, you know, anything that's been issued onto it up to this point.
Yeah, the best way though to avoid properties like this is just using some common sense as you're looking at the properties, trying to decipher the type of property that, you know, that it is. And so if you're looking at you know, property that's zoned as, you know, commercial or industrial, and it has remnants there of, you know, previous business, you might look into it, you know. But for the majority of these property investments, it's not too big of an issue.
Yeah.
Government liens, though, they can be an issue. You know, certainly something that we always want to check for, because what we want to avoid is buying a property only to find out, you know, that it has liens there against it, because then we're in a position there where we may be forced to pay them, you know, in order to maintain ownership of the property.
Yeah, and with governmental liens, this isn't necessarily something that we're going to research on tax lien certificates. You know, unless we were buying high dollar tax liens and we were concerned, or we had some kind of concern against it, we're not going to worry about looking to see, is there a grass lien against the property, or is there anything like that? Because, you know, chances are 95% of times we're not going to ever become the property owner.
Yeah, they're just going to end up redeeming, and because we're not dealing with direct ownership, it just doesn't really matter for us.
But on tax deeds, that's a completely different story, because there could be, you know, a city lien against it, and a city lien could be as little as $150, or we've seen a city lien that are as high as $15,000. And so, you know, you buying a property, oh, $150, that's not a big deal. I can go ahead and pay off that lien and I'm still going to be profitable. Where a $15,000, you know, lien on a property that may only be worth, you know, 20 or 30 could completely ruin your deal.
Yeah, we've literally seen liens, you know, that were bigger than the property was worth, and you know, liens that destroyed any chances of wanting to be interested in that property. It's specifically, though, it's not any type of lien. There's only a special class of liens that can that we worry about, and that's because most liens, most claims against the property, period, are wiped out in the foreclosure process, in the judicial foreclosure that the property is taken through when it is foreclosed on. You know, that judicial foreclosure has the power to wipe out or extinguish claims to the property, and it wipes out most of the liens or claims that may exist there. What it can't do, though, is wipe out first position liens or, you know, government issued liens. It can't wipe those out because they have priority over all of the other liens. And so that's why we look for the government liens, is because literally they're the only ones that can survive that process afterwards. And so they're the ones we can't get rid of.
Yeah, and one quick tip on governmental liens: if you do find a property that you have an interest in, but there is a governmental lien, contact that government official and find out if they're willing to negotiate on that lien amount.
Yeah, most of them will, because they have a ton of inventory. You know, they have money that just they need to collect, and they would rather collect, you know, some of it than none of it.
Well, and if you say, hey, you know, especially if it's something like an over-the-counter or even an upcoming auction, say, hey, I'm interested in buying this property, but at this lien, it's not going to be worth it. It's just going to be sitting on your books, you know, and you know, sometimes we'll see these with over-the-counter properties where they weren't purchased because there is some type of governmental lien, and those are the perfect type of properties to approach that, you know, government and say, hey, this is sitting on the over-the-counter books. You know, nobody has purchased it. It's not making you any money. Let's go ahead and negotiate down this lien and get it for, you know, 10, 20, 30 cents on the dollar.
Yeah. Now, one of the questions we have here is, what are the ways of knowing if there are any liens against the property? And that's a really good question, and it's really kind of at the heart of a lot of the research and due diligence that we do. A lot of what we're doing is trying to establish that the property has use and value, and figure out exactly how much we can sell it for. But beyond that stuff, all of the work that we are doing, the research, is trying to help us identify risks like liens. And in order to find those, we have to go and search for them. In fact, it's really the only way to find them is to search them in legal records.
Yeah, exactly. That's where we're either doing an investor title search, if we're buying the property, or we're researching all of that information ourselves. If we're spending enough money, or if the needs be, we could look at doing title searches as well. But that's essentially that investor title search. We've got the different webinars and trainings that we've done, and we'll go over it again here in the future. It's just those steps of going through researching the assessor records, the tax records, and the court records.
Yeah. Basically, we're doing that. We're using the past owners, recent past owners, to try to look into any records that might exist out there on the property. We're looking at the property deeds as well and learning more about the property. Sometimes that's where we'll learn about things like an easement. An easement is the next risk here, and an easement is basically the government reserving the right to use the property for a certain purpose, and it's one that we can't interfere with, essentially.
Yeah, now some easements are no big deal, and some easements, it's really the only property use is that easement. So, to kind of give you an example of what an easement like that would be a drainage ditch or a water basin. Or sometimes you've seen little power stations or things like that where the property is only being used for the easement. There's no other use for the property other than the easement itself.
Yeah. Now, so the other questions here, does the county take no responsibility? No, they're not going to take any responsibility. In fact, one of the things you're going to see the county will say again and again is, is like, do all of your research on these properties. They're always telling people to do it because they have so many people that will just buy without knowing what they're buying. But yeah, if you buy a property from the list and it has liens against it, the county is not going to care. That's just part of the game when it comes to these tax sale properties, is researching that and knowing what that is beforehand. And
yeah, now there's some other type of easements that are only you're still going to have use of the property. For example, you may have a large piece of property and there's an easement through the end of it where somebody else will drive through, or maybe there's a road on the end of your property that somebody else can access their property to. Or there's an easement where at the end of the property they have power lines going through it. Those type of easements aren't ones that we're going to be really worried about. It's really the ones which, are being where the easement's affecting the value and use.
Yeah. Now, another good question here that Victoria's asking here is, what is an investor title search, and how does it compare to a title search? This is a really good question. So the problem with most title searches, obviously, is that they're not free. They cost money, and for us, the majority of the title search is kind of overkill. I mean, when you have a professional title search performed, they're really digging much deeper than we're necessarily all that worried about. And one of the reasons for that is because the property's just been through this judicial foreclosure that wiped out a lot of the things that were attached to it.
Yeah. So essentially, the investor title search is just going through the process of researching those records ourselves. So we're researching, court records, looking to see is there any liens that have been placed against the property owner that may in turn be attached to the property, and really determining that. And so, we do that ourselves. In fact, we have set trainings that the entire webinar is based on the investor title search and teaching how to do that.
Yeah, and that's basically what we're doing is we do some research into the property title to determine exactly if there are any liens like that against the property. And we call that an investor title search, as opposed to a professional title search, where you're going to have, well, like most people know of, with professional title searches. So, yeah, they're kind of a halfway in between step here. And a lot of really good questions here. Can you talk about, so with Peter here, can you talk about utility easement? Also, from your experience, what situations where utility easement is okay? So I think with utility easement, he's probably talking.
Yeah, well, it's really going to depend on, is the utility easement just a portion of the property, or is it pretty much being used as the utility? I mean, is the property's being used for the utility?
Yeah. In other words, does it have value outside of the? Is it a residential lot that just happens to have an easement on it, or is it just a particularly large easement?
Yeah.
Yeah. That's what we're trying to figure out usually.
And usually it's pretty easy to see. Like if you see, let's say you're buying an acre lot, and at the back of it, it has utility poles going along the back of the lot, there may be some type of easement, for the utility company and for that within there to be able to do it, but that's not necessarily going to affect the lot's value.
Yeah. So if the property has value in and by itself, and there happens to be if it has use and value, by itself, and it happens to have a utility easement on it as well, then we're not going to worry about that too much, because it's just kind of something in addition. But if it can't answer those first two things beforehand, then the easement can only make it worse.
Yeah.
Now, so really an easement would be okay if the property had any kind of value outside of that, if it's something that can be used. And how do we evaluate it? So that's a really good question too. The first way that we evaluate for easements normally is actually visually.
90%, 95% of properties aren't going to have them.
Yeah, and so we're looking at the property, and we're looking at things that might potentially be an easement. Like for instance, whenever we look at properties, we're looking at where drainage is around the property, and because that's something we're always looking out for. We don't want to pick up property that has some kind of we don't want to buy a ditch, basically.
Yeah. I mean, really, they're so rare in some cases. I mean, as you get out into bigger lots and things, they'll have more easements, and they're all going to be on the deed. Usually they're going to put them right there on the deed.
I was just going to say that. That's the other thing that we check is if we want to know for sure, then in the legal description on the deed to the property, we can generally find the easement that is listed there, and so sometimes we'll just go directly to the property deed to read what the easement is directly.
Yeah, it's really not that big of a risk unless you're buying an easement property like a drainage basin.
Yeah.
There's a property in Arkansas that we were looking at that's fooled students over the years, just looking at it, because from the top view it actually looks kind of like a nice lot, when it's not filled with water. And so as you're looking at it dry, it just kind of looks like a grassy lot. But then when you go down to the street view, you can see, oh no, it's not. It's a drainage basin. It just happened to have some grass in it. It's actually 15 feet deep, and is used nothing but that being used as that easement.
Yeah. So it's interesting though. The easements aren't generally something that are going to stop us from investing into a property, because most of the time, it has value that kind of stands on its own, and is the type of property we'd pursue, or it's a junk property.
Yeah, for the properties that do have like an easement on it like that, they're almost non-relevant.
Yeah.
Like it's just part of the you've got a small utility easement because they have something, pipes running through the side of your yard. All you need to know is can't dig there, at that part, because there's pipes there.
Yeah, outside of that, it won't affect
Outside
your
of that,
ownership.
it's not going to make any difference.
Yeah, and so, most of the time, they're not really going to be a problem. And if the easement is a problem, it's normally going to be pretty obvious from the outside of it. Like there's fencing all around there because there's a little ditch.
It's only being used as an easement.
Yeah, and so most of the time that stuff will pop out and it will kind of reveal itself. And if so you'll see it visually, and then if you want to confirm it, you can pull up the deed and read exactly what the easement is. But in most of the cases, though, it's something that we naturally, we kind of sift through naturally. So, if it's got some major problems there like that. But most of the easements, though, are not going to be a major problem, except for drainage easements. Obviously, drainage is something that we try to avoid in general.
Yeah.
It's easy to buy a ditch.
The number 8 is personal liability, and this doesn't have as much to do if you're purchasing tax liens. Eventually, a lot of people, if they are doing a lot of tax lien investing, may put it like in a self-directed IRA account or something like that. But if you're buying tax liens, we don't have a huge amount of risk as far as liability because we don't own the property. So if somebody slipped and fell, they couldn't sue us or anything like that. But when it does come to tax deeds, that's where personal liability can come into play.
Yeah, it can begin to become an issue here, as you begin to acquire additional assets, especially as you begin to acquire real estate, in other states. So, it's a good time to, which if you're actually at that point where you're starting to acquire real estate, then really you're at a point anyway where it's going to make the sense, from just a tax standpoint, to get things set up with a business entity.
Yeah, exactly. So we just want to protect ourselves because of things like, injury or something like that. I mean, really, it's the unknown. Besides that, it's just smart business. You're going to have, tax write-off. You're going to be able to protect yourself. And so regardless of, you could start buying property in your own name, but as you build that business up, you're going to want to protect it.
Yeah, absolutely.
Asset protection as well.
Yeah, so number 9 here applies to tax liens specifically, and we're talking about tax lien roll-up. With tax deeds, we don't really have to worry because the opening bid for a tax deed essentially is the roll-up. That's how tax deeds work. The opening bid is always going to be the total amount owed in taxes and fees. But tax lien roll-up is something that we always want to be looking for whenever we go to buy a lien. So in fact, when we go to buy a lien, we want to make sure the property has use and value, of course, but the main thing that we're trying to look at and determine is what that roll-up amount is compared to that value.
Yeah. And, some states are going to be more notorious for this than other states. For example, South Carolina, they only have a year redemption period, and after the year, most counties go ahead and issue deeds on the property, so you're not going to ever have to deal with roll-up. In some of the other states, you need to start foreclosing within 2.5 years or 3 years.
Yeah, which, that's actually a good thing in some ways because it limits how much time, a lien can just sit there accruing interest forever.
Yeah.
Because the problem that begins to arise is, if you've got a lien that's constantly accruing interest, that can build up quickly. But if you've got multiple liens against a property and they're all accruing interest constantly, then that property can very quickly become ridiculously underwater to the point where nobody's ever going to buy it.
Yeah, and there's a lot of states that could have these, that you're going to need to watch for, but really the most important states are going to be like Florida, Arizona. Those are the ones that are most commonly going to have huge roll-up, or where roll-up could be a problem, because in the state of Florida, they have 7 years before what's called a 7-year life of lien, which means that for 7 years, after 7-year period, that lien is no longer valid. And so essentially, if you invested in that lien after 7 years, if you don't start the foreclosure, you lose your money in your lien. So they're trying to, essentially force property owners to start the foreclosure process. Well, that means there could be 7 years worth of back tax liens.
Yeah, which can end up being a large amount of delinquent taxes that are owed, way more than you want to pay in most cases. It's a good recipe for a property roll-up amount that just doesn't make financial sense, given the property value.
Yeah, exactly. Kind of here in this example here, we're looking at a $10,000 building lot, and let's say there's a $500 tax lien. Well, if you were to buy that, you're buying it for 5 cents on the dollar. If there was only another lien on it, you could maybe foreclose on it for 10 cents on the dollar. That could be a good investment. Well, in looking in more to the tax lien, there's a tax lien from 2018 and 17 and 16, and added up all those taxes. Well, then suddenly the roll-up amount is $6,200. So instead of, you looking at this lot, well, I'm looking at $500 on a $10,000 lot that has a good bid to value ratio. We're actually looking at $6,200 on a $10,000 lot.
Yeah, which would be a total waste there, for that kind of a property. That's why we always want to check for that roll-up amount. We don't want to commit ourselves to a financial investment that we don't want to make.
No. The last one is condemned property, and really this could also include major rehabs. But this is really the biggest risk with structured property.
Yeah, this is why improved properties or structures require another level of due diligence when it comes to the evaluating it. It's because you are committing yourself to that property and what could be a bigger financial commitment as well.
Yeah, well, if you bought the property with in terrible condition, regardless of how much you bought it, it could be a terrible deal. Yeah. You could pay $100 for the home, but if the home needs $50,000 worth of work and the home's only worth 40 grand, yeah, you're $10,000 in the hole to even try to get out of the property. And so, one thing that we're always going to recommend with structured properties, always, is do either an on-site evaluation by yourself or send somebody out there to take current photos of the property and send them back so that you can look at the condition as it is right now.
Yeah. You also need, to have somebody that can, do a more detailed look at, different parts of the property, that could potentially need work or issues that may need to be addressed. Sometimes just a photo or two of the property isn't enough. Sometimes you need somebody that that's actually looking for problems.
Yeah.
And that's going to be one of the best ways to help you identify, particular issues there with the problem. But when it comes to these, Google is pretty well useless.
Yeah, well, it's good to at least get an idea, but we can't take that condition as gold. Here's a property that we had done an online evaluation for in 2014, and you can see that there's still somebody living in there. The windows, it's not necessarily the most sexy home, but it's livable, usable.
Mm-hmm. And it looks like, potential opportunity, but from, an on-site evaluation, shortly after, we can see that even though it's been a relatively short time frame since that time, less than 2 or 3 years here, but dramatic changes to the property. And we can see also, more angles and things are rougher. It tells us a whole different story.
Yeah, well, we can see the roof is got some type of problem where they put board or something over it. It looks pretty bad. You can see that the front window is actually open, that, the home is completely trashed.
Yeah, totally.
It's no longer livable. And if it's been sitting for 2 or 3 years, we don't know what type of problems it could have. We don't know about mold. We don't know about all those things. And so if we are investing in structures, like we mentioned, we need to, either check it out ourselves or send somebody like a handyman that has an idea of real estate and say, you know what, I saw this here on the roof. There's a hole on this roof that, on this one side, I would avoid it. That could save you just, having somebody that looked on it could save you from making a huge mistake.
Yeah. We also have different kinds of properties that we can target or go after. And these are going to be properties that represent the lowest amount of risk, which that could mean, these are the liens that are most likely to redeem, or if we foreclose, they're worth it, or these, could also be the kinds of tax deed properties that we try to target. Any of these, some of these have improvements, some of these are simply land, but they represent the properties that we want to buy.
Yeah, essentially, this is just a list of properties that have both use and value.
Mm-hmm.
That's what we're looking for. When we look at the high risk properties, these are properties that don't have use and value. Either they have underwater roll-up, like we showed you, where the amount to foreclose doesn't make sense. So suddenly, the liens are no longer enforceable.
Yeah, we have many of the different types of issues that can plague these problems that don't have any value. Sometimes it's about where they're located at, or their size, or a lot of other things. It can be about issues that the property can have. But either way, we avoid any of these, property with easements or condemned structures, anything that's landlocked, or major rehabs. We want to avoid things that have little to no value, or are underwater, like Steve mentioned before. Anything like that are all warnings. They're all red flags for us whenever we're looking at potential investments.
Yeah, well, and especially when we talk about rehabs, if we're looking at the lower end value of homes, homes that are worth 30 to 40,000. That's where you really need to be careful, because even a cheap roof could cost $5 or $10 grand.
Yeah, it's really easy for
and so if you just have the roof, well, now you're into a 10 grand. Property's worth 35.
Yeah, and that could be that same price. The same price to put a roof on, whether the house is valued at 150,000 or 50,000.
Yeah, and those things may not be a deal killer. It just depends on the overall condition of the house. You could still make 20 or 30 grand on those type of homes, as long as the condition is right.
Yeah. So anyhow, well, we've gone over here on time. We apologize for keeping you all so late, but we do thank all the participation. You guys had awesome questions here tonight, and we love getting the questions. If there are more questions you'd like us to answer, or anything we didn't have time to get to tonight, please send us an email, and we would love to get back to you.
Yeah, have a good night, and thanks again.
We'll see you later.